Hey guys, Casey Dim and TaxLawAcademy.com. Let's talk about the real estate market crash. You're buying all these properties, you're flipping them, you're making loads and loads of good old cash, and then suddenly, boom, the market collapses. Let's talk about market collapses for a second. First off, every market is going to run in a cycle. And some market conditions will be worse or better than previous cycles. The so-called experts say that a real estate downturn is going to happen, of course, but it won't be as bad as 2008. It's a cycle. That's what happens. Don't panic. Instead, you need to learn how to profit from it. Now, if you saw my video from a few days ago, you know about my experience with the market cycles. If you didn't see that video, search my YouTube channel for 2008, and that video is guaranteed to pop up, okay? So anyhow, I'm going to give you my 3 tips on dealing with market cycles, specifically real estate market crashes. Although crash is probably a little bit of a strong word for what's coming, but it looked good in my YouTube channel, okay? So these tips aren't from like so-called financial geniuses, and they aren't from the U.S. Treasury or anything like that. These are my tips. These are from a tax sale investor who went through it last time and saw lots and lots of people lose money, but also saw lots and lots of people make loads of money during the downturn. This is what I learned. These are my 3 tips. Number 1, be somewhat realistic. The best way to ensure that you go bankrupt is to needlessly and hopelessly go all in on something just because it happens to be working right now. And I absolutely get it. Do more of what works. But don't do it to the point where if it stops working, that you're going to be in financial ruins. Here's a prime example. 2005, 2006, I saw some very, very small builders who were building, selling, and profiting from spec homes non-stop. They leveraged everything for the business and through their personal life as well, just so they could do more, build more, sell more, and subsequently make more money, which is fantastic until it isn't. If the market slows down and you have 150 spec homes out there that are in some part of the construction phase, and you're typically like a 9 to 10 home per year type builder, you can imagine that they just won't have the same staying power to float or to finish these projects until they're sold. On that same note, maybe you're the speculator who's buying all this stuff, waiting for the market to surge so you can sell it at the very top. Well, guess what? If you do this long enough, that market's not going to surge and you're going to be selling at the bottom instead. So you also need to be realistic with your income and your expenses. The moment that you make your first $10,000 is not the time to go out and buy your first Rolex watch. Or the moment you make your first $1 million is not the time to go out and buy an airplane or a yacht. I'm all for having very lofty goals, being very optimistic, and even rewarding myself. But I can tell you without a doubt, looking back, the ones who suffered the most during the economic downturn were those investors with the pie in the sky, it will never end, and I have all the money in the world type attitudes. I saw it countless times. Don't let that be you. Number 2, see it coming. I know, if you could see exactly what would be here, you'd be like a financial expert, okay? But here's what happens to so many people, especially those who are making loads of money during peaks in the cycle. They get tunnel vision, and they don't think that it will ever end. Contrary to popular belief, the real estate market doesn't just decide to crash one day. It's not like you wake up March 21st, 2021 at 4:07 a.m., the market crashes. That's what everybody envisions because of the media or something, but it doesn't work that way. Depending on the specifics that you're analyzing, the last market crash took close to 2 years. Home prices began to fall in late 2005, and the recession is said to have officially started in December 2007. That's 2 years. That's a very long time, if you can see what's happening. I sell most of my properties in less than a month now, so it's very easy to gauge the prices and the fluctuations in value. I also only invest in foolproof investments where there's plenty of margin. So the market drops a little bit, it's not really going to affect me all that much. But if you're a longer-term investor, you like to hold for a year before you sell, or maybe you're a speculator, then you really need to keep your eyes wide open, watch the values in your area, pay close attention to the days on the market, to the sales price increases and decreases, to the fluctuations between these asking price and the actual sales price, all that kind of stuff. Don't think the market will always be at its peak, because it will not be. And number 3, and this is the one that really excites me, make adjustments. It's something that took me a while to figure out. I know a number of investors who actually made substantially more money during the downturn than they ever did during the market boom. In fact, some of my personal returns, once I kind of figured this out after a year or two, were actually significantly higher on a per property basis during the recession than during the real estate peak. Now, again, it took me some time to figure out exactly what works, but once I did, my income shot up tremendously. When the market slows down or even bottoms out, you must make adjustments. And you need to make those adjustments as fast as possible. Don't try to make whatever you're doing continue to work nonstop, because it is going to stop. What works in the market peak does not work in the market recession. Instead, figure out how to diversify property types. Figure out what properties are still selling. Figure out who you can work with as far as other investors, what they're buying and what they're selling and what they're utilizing right now to make money. Because, side note, there's always going to be somebody investing in real estate, and you need to figure out how to sell your properties to them. Make your adjustments and press forward. Guys, the good thing about tax sale investing is that these are tax defaulted properties. These aren't properties that were over leveraged and bank foreclosed and the bank's trying to squeeze every dime out or anything like that. These are properties where the taxes weren't paid on them. The taxes owed on them will usually, of course, be substantially lower than the value of that property. Even if the market takes 50%, you're still going to have lots of equity if you buy it correctly at the tax sale. So if you do everything correctly and you don't try to force the same old investment strategy to work, tax sale investing is actually going to be your best bet when it comes to investing in down times. And where the market is up, down, sideways, whatever, you can always make money as a tax sale investor, especially if you follow those tips. Be realistic, see it coming, and make adjustments as needed and as quickly as possible once you determine those adjustments are needed. Guys, please do me a favor, and if you enjoyed this video, hit that thumbs up button and subscribe to my channel so you don't miss out on any future videos just like this one. That's going to be it for today, guys. If you're looking to get more information on investing in tax defaulted real estate, head on over to taxsaleacademy.com. 2 resources while you're there. You can watch my free web class by clicking on the web class link. You can also grab your free copy of Tax Sale Playbook as a physical book I want to ship to you. Just help me cover shipping costs to get it from my warehouse to your front door for $4.97 inside the United States. That's it, guys. Have a wonderful day. Take care. Bye-bye.